Okay, so now let's just take a look at the CMBS market. Little nuanced differences, but generally pretty much the same thing as the mortgage-backed securities or MBS or residential secondary market. Now, one difference that you'll note right off the bat is they have a slightly different structure in terms of the payout, but the process is still the same. So if you purchase a AAA tranche, then you're paid very much like what we saw with the A in MBS. And then there's a sequential pay classes on down with these subordinated elements absorbing most of the risk, and many of them not getting paid until these guys are all paid off. It varies depending on how it's structured and what the rating process is within the tranche. Keep in mind, in some mortgage pools, they don't go all the way down into this B minus and double B, etc. They stop at A. During the financial crisis, one of the things that we ran into that created some problems was that the rating agencies were rating the entire collateralized pool of both CMBS and MBS as AAA. So in other words, they were suggesting the probability of default across the entire pool was pretty much equal and was relatively low. And of course, as we come to find out, that was incorrect. And part of the reason for that was based on the information that they were receiving and the reality that it had been that way for a long period of time. Residential and commercial real estate, secondary market loan instruments and securities were considered strong, safe, high return investments. I think this is a pretty telling graph of the process and activity of CMBS loans. As you can see, it starts in illustrating about 1996. CMBS took off, initiated in around 1990. It didn't really take off, as I wanted to say earlier. It didn't take off until about 2000. As you can see, there was a rapid escalation across the country. The blue representing U.S., black foreign, and then the agency or CDO versions. And then in 2007, with the financial crisis, it collapsed, and there was almost no heartbeat for many years. It started to bubble back finally around 2013 and 14, and it's been pretty much a modest version of its former heyday in 2005 through 2007, largely because investors have found other sources of debt capital beyond using the CMBS market. So they've substituted it. They're using direct lenders, and they're using insurance companies. Insurance companies have come back into play, among other entities. And there are sovereign funds and hedge funds that are actually designed specifically to purchase debt straight out of the deals. Well, one of the reasons why you see that collapse in issuance of CMBS is that the perception of risk, and we've seen these kinds of graphs in the past, but the perception of risk in real estate became such that it drove the cost of funds up dramatically. So this is a AAA CMBS versus the Treasury and the spread between those two. And you can see, of course, it started around 08, starting to head up, and it spiked dramatically in the end of 08 and early 09, and stayed for quite some time before it finally came back down to a more modest 200 basis point spread. I'll let you know that not only were we still, kind of in the middle of a recovery in 2010, but one of the other things that was going on during this period of time was there was so many loans that were being worked out or extended by financial institutions, and because of the erosion in value, because of the recession, nobody was interested in loaning folks money to refinance or reconstruct those loans that had come due during this period of time. Keep in mind, commercial loans, they run 5, 7, 10, 12 years. And if you'll allow me to cast back, remember all kinds of activities happening in this period of time, right? 2004, 2005. So that means 2009, 2010, 2011. There's a lot of loans coming due, and we're still crawling out of a recession. And so it takes a while to get all that reconstituted and cleaned up. As you can see, by the time we get to 2011, it's finally starting to smooth out. A lot of colleagues that I knew in the banking industry spent all day long for 2 and 3 years doing nothing but working out commercial loans to try to get those folks refinanced or get them recollateralized with additional equity inputs to balance out the loan to values, and all sorts of things that caused a great deal of consternation in the commercial mortgage market for a while. I told you in the previous deck that there are times when you create CDOs off of a single deal. And this is the way I set this one up as an example. And so I'm going to walk through it with you. And the reason why I want to walk through it is because I want to get to this point here where I get to the capital stack, okay? There's a couple pieces in here you'll recognize. So let's just assume for a moment that we have a single property, or it's a commercial portfolio that someone's purchasing for $500 million. They're going to go and borrow they're going to raise $100 million equity. We're going to divvy up that equity here in just a little bit as well. But let's go this up here at the top and work on the commercial debt. The commercial investment bank is going to issue this debt for us. They're underwriting it is what it amounts to. And the way they're going to structure it is they're going to put a tranche for $300 million, and they're going to assemble the B tranche for $100 million. That is brought down into the CDO, the $100 million. The $300 million becomes the CMBS. So it's the A note, the A piece. We're going to split it up or tranche it into 2 more classes. And what we end up with then is a whole litany of these different distributions of pay in equity and debt across this single investment. So walking through this, again, this is the $300 million CMBS that's issued in dual tranches. Then we have this pool, which involves or includes a $100 million B note, 25 in a mezzanine debt, and 25 in preferred equity. What's mezzanine debt? In essence, it's a lower pay tranche than any of the debt that's there. So it's the last debt to get paid. It's a bit like a second loan on your house, in that if the property was foreclosed or defaulted, then the A note would be paid first, the B note would be paid next, the mezzanine would be paid after that, if there was anything left. Of course, preferred equity represents the equity investors that are getting paid a preferred return. And then common equity is just equity that's getting paid profits that don't include a preferred return. Back to this mezzanine debt, it's important to understand that in most cases, the way it's structured, the holder of that debt does not have a claim on the asset, unlike someone in this position here, and even this position here in many cases. Mezzanine debt is debt that is underwritten on the cash flows of the asset, but does not include the value of the asset in the event of default. So keep that in mind when you're thinking about this. This distribution here of debt, structure, mezzanine, preferred equity, and common equity represents what is known as the capital stack. So each deal is broken up by its capital stack, and the distributions are of importance to folks that are engaged and invested in this particular asset, whether it be on the equity side or on the debt side. And now you see how it's put together, how it's structured, how all these things get divided, how the debt can be parsed out in a number of different ways, and how we issue these various securities based on compositions of this debt and equity in the entire deal. I hope you have a better flavor for how these are structured. We'll have an assignment that takes a look at the secondary mortgage market from a multifamily standpoint. Specifically, we're looking at the performance of multifamily loans, and I'll describe that in another slide issue. Till then.